First, let me thank Supergen Energy Networks Hub for organizing this talk. Just for those who don't know much about the Hub, Supergen Energy Networks Hub researches on energy networks and energy network infrastructure across various vectors of energy, such as gas, electricity, heating and cooling, and even hydrogen. Our focus is on understanding the interactions and interdependencies between different networks. We are very proud to have a community that is well diverse and quite vibrant, and it integrates industry and academic partners across the country, but also we have an international arm as well. Let me add that we are ably managed or directed by Professor Phil Taylor, based at the University of Bristol, and other co-directors from Leeds, Manchester, Bath, Cardiff, and then Newcastle. Today marks the beginning of the Green Infrastructure Week, and our hub is keen to observe this week, but with 3 live webinars, the details of which are on our website. The first of the webinars is going to be today's talk, which is on climate finance, the road to net zero post COP26. So yes, finance is a vital part of this transition that we are looking at, and we need experts and other stakeholders to understand how to navigate this facet of the transition. So today's lecture, we have Professor Ian Klutcher. Thanks very much, Ian, for coming. Thanks for accepting to speak to us. Just a bit about Ian. All I know about Ian is that he's a professor of pensions and finance, and he's the Pro-Dean for International at the University of Leeds Business School. He's also the head of the university's new Center for FinTech and Innovation. And at the moment, he's one of the leads at the Center for Greening Finance and Investment. Ian leads the Climate and Environmental Risk Analytics and Pensions and Asset Management. So please, Ian, you have the floor now. You can share your slides, but also to let audience know that we have a question and answer session that follows after his presentation. So what you can do is to note your questions in the chat box, and then we'll give you ample time to ask them. Thank you very much.
Thank you very much, Richard and Lindsay. And I'm very pleased to be speaking to you all this morning, and I do appreciate showing up for a finance talk at 11:10 on a Monday. That's a level of commitment that's not common. So let me just share my screen, and hopefully all the technology keeps working. We all good, Richard? Can you see that? Excellent. So just a little bit of background about me. So as Richard says, I'm a professor of pensions and finance at the University at Leeds, and throughout my career I've always been focused on questions around pensions. And from very early on, I did my PhD in pension accounting, which is as interesting as it sounds. And I've also done work on decision making in pension funds, so looking at behavioural biases in trustees. I've looked at behavioural biases at an individual level. I've looked at asset management. So when we talk about asset management, we're talking about the industry that invests most of the pension fund money that is saved by individuals. I've done work in actuarial science. So I've had this very broad, it's one of the reasons I like pensions, is it is very broad and there's lots of aspects to it that you can then investigate and research and so on. And that brings me to climate and the transition to net zero, because if you look at pension funds, even if you take a defined benefit pension fund where there are no new members coming in, there is no future accrual, and the scheme closed 10, 15 years ago, those pension fund assets are going to butt up against the transition and they're going to hit the 2050 cutoff point. So all that money that's invested, if we take the UK, for example, 2.5 to 3 trillion pounds of money, all of that is exposed to the transition. And so actually understanding how we can bring climate science into the decision making becomes really important, because that money has a time horizon that is also compatible to the transition. So if we can use the money that people are saving to fund the transition, then that seems like a very sensible thing to do. And if we can protect those investments from the worst excesses of climate change, whether that is assets stranding or anything else, then again, that's a very sensible thing to do, because ultimately, if those assets strand, somebody's not getting paid a pension. So that's the sort of overarching context for why I think this area is interesting, why I think it's important. And it's what I'm probably going to spend the rest of my career working on, if I can sort of make it happen in that way. So just a little bit about the UK Centre for Greening Finance and Investment. CGFI is a £10 million research centre. It was funded by NERC, so the Natural Environment Research Council, and is a consortium of universities led by Oxford with Leeds, Imperial, Reading and Bristol. And essentially, it is about the translation of climate science into things that can be used for financial decision making. When we talk about financial decision making, we're talking about institutional money. And by institutional money, that means large global banks, it means building societies, pension funds, asset managers. Actually, we've done some work with the Bank of England on climate stress testing. And so what you're looking at is, when you think about finance, we're talking about big finance, where money is held in large pools. And more often than not, or for quite a lot of that money, it has quite a long-term orientation. So we're not talking about trading, so buying and selling in short term. We're talking about people who are investing for the long term. Now, our ultimate vision is essentially that financial institutions in the UK and internationally will be able to access climate environmental risk analytics and data for any point in Earth, past, present and future, in every major sector, and it will cover material, climate and environmental factors. So not exactly a small goal. And what we're looking at is, if you look at financial regulation, so prudential regulation is concerned about systematic risks, okay, system-wide risks. And so if you take the global financial crisis, there was a systemic failure in the financial system. And so what we're trying to do is take that as an example and say, well, if you look at systematic risks, how can you then try and manage and mitigate against them? And climate is clearly a systematic risk, and finance is clearly highly exposed to it. That's the money that's saved today, but also the money that's going to be invested tomorrow. So we need to make sure that that sort of resilience is built into the financial system, because it will help fund the transition, but it will also mean that the purpose of finance, why we have mortgages and pensions and so on, that can still exist, because they have other functions other than trying to mitigate climate risk. Now, I always have some trepidation about presenting in general, because I always like to start from setting out the scale of the problem. So I do apologise if this is preaching to the choir to some extent, but I do think it's sort of poignant when you look at the scale of the problem, and then when you look at where finance is roughly at just now, because I think there are some big gaps that we need to understand and then think about how we can mitigate them. So the problem, as we all know, is CO2 from fossil fuels, largely from fossil fuels, and it's just catastrophically big. And the challenge of something like removing carbon from the atmosphere is just off the scale. And if you look at just since 1950 through to 2020, we are looking at such an unbelievably large increase in CO2 emissions from fossil fuels around the world, that this is a problem that is not improving, it is a problem accelerating. And if you even go to the sort of, there are some debates, I suppose, you could have around when was this problem first really identified. And there's actually news stories going back way before 1950. But I think there was testimony from to Congress about this in the sort of early 80s about the extent of this being a problem. So if we to just take that as a reasonable starting point for when this was identified as a problem, to the extent that it became politically visible, and you look at what has happened to emissions, while this is now a 40-year-old problem that is now well known, there is very little that shows a direction that takes it seriously. So the world is growing in a way which is not compatible with a sustainable climate and limiting global warming. We also have sort of just unbelievable statistics about the extent to which this is a problem. So if you look at the atmospheric concentration of CO2, 400 parts per million, and it will be worse now, is just an unbelievable challenge because it's so hard to remove. It makes up such a tiny portion of the atmosphere, but its impact in the long-term warming of the planet is so as somebody coming from a finance perspective, I can't quite get my head around how something so tiny and small and so rare within the atmosphere can have such a large effect. But it gets worse. It's not an improving situation. So if we then look at methane, which is considerably more impactful in the near term, I think this was yesterday or Friday this came out. Global monthly methane has hit its highest point ever. And again, we've known about the methane problem for a very long time, but not enough has been done. So we have this significant problem that everybody's aware of. We can see what is causing us problems in the near term. We can see what is causing us problems in the long term, but we're not making any real traction on it. And this is where it becomes a huge problem. And then for me, the question is, what is going on in the world of finance and how can that then potentially be brought to bear on this problem? So the world with no sort of policy changes hits 4.1 to 4.8 degrees probably in about 2100, at which point there's not a lot left on this planet that makes it habitable. So what we're looking at there is we are moving away from that, which is good. If you look at current policies, and this is slightly out of date now, but not by much, if you look at the sort of predictions around the COP26 pledges, is 2.7 to 3.1. Pledges and targets got us to 2.4. We know Paris said less than 2 by quite a margin, but 1.5 if would be much better. But the thing about 1.5 is it doesn't mean there are no bad outcomes. It just means the outcomes are less bad. And just now I think the sort of COP26 pledges get us into this bucket of around maybe just a little bit under 2, maybe just a little bit over 2, but these things are all quite highly uncertain. So what we're not seeing is a significant shift in the policies that get us to 1.5. So I don't think 1.5 is dead as a target, but I think it's quite hard to now achieve, and it's going to get harder for every year that we don't do something about it. And the other thing about that is for every year that something is not done, the cost of doing something about it becomes ever greater. So for every year that we defer, it costs more money to try and fix the problem because it becomes ever more difficult. If you look at sort of policy targets, we have a very small number of countries that have achieved net zero. Some of these countries have got sort of environmental advantages, and they also have particular forms of economy that are not highly dependent on carbon. We have some countries that have put it into law. If you look at Europe, for example, UK, France, Germany, and a few other countries. We've got Canada and so on. Japan have put it into law. We have in policy documents where net zero carbon emissions appears in policy documents, but it's not as stringent as a law, but you would hope that direction of travel there is better. And then we have sort of pledges to varying degrees. And then there's a lot of the world that we just don't have data on for this. So if you think about the previous slide, then if everybody meets their targets, then we might get to about between 1.5 and 2 degrees, say. But if it's in a policy document, that's not a binding commitment compared to being in law. And even by being in law, it doesn't mean you're going to actually achieve it. But it does set out a direction of travel that is a little bit more convincing than a sort of notional pledge that, well, we accept that this is a problem and we'll do something about it. Now, I was very fortunate to be at COP26 for a couple of days in Glasgow, and it's the first time I've ever attended COP, and it blew me away by the scale of it. So because it was in Glasgow, I knew the venue where it was being held, and it looked like nothing I had ever seen. I found it disorientating, and I knew where I was going. But one of the things that I found quite compelling was this kind of groundswell of activity across the world, all coming to one place to focus on this problem. And from talking to people who have been at multiple COPs, going way back, they said that COP never used to be like that. It used to be a very small group of, or a relatively small group of climate scientists and environmentalists and so on, and a few bits of policy and government. And through time, it has grown into this other thing. It's a huge gathering which really is trying to focus on making a material difference. And one of the things that I found, again, quite compelling was the fact that so much of the world was there and represented, where you can then start to feel that people are now looking at this in a more holistic way. But this was a presentation I attended at the WHO pavilion, and it's really resonated and stuck with me. And I think there's various versions of this, but what we have is the world rescaled by carbon output and carbon impacts. So on the top, what we have is the countries that have had the most impact on the climate, i.e. they have produced the most carbon. And so obviously you see the UK swelling up quite significantly there, North America, particularly the US. But if we look at, say, North and Sub-Saharan Africa, it that disappears almost compared to its relative size in a normal map. So what you're looking at is all the carbon has largely been put out by the global north, and a lot of those impacts have been massively felt in the global south. Because if we look at the second figure, which is the one below, the US declines to a small sliver, the UK shrinks away, and Sub-Saharan Africa blows up massively. It's hugely inflated, and this is where we're seeing the health and effects of climate change. But my reading of that as an economist is also slightly different. So what we have on the top is the economic benefit of the carbon economy, and on the bottom we have the economic costs of the carbon economy. So there is something going on with the climate and what has gone on previously that says all of the economic benefit of climate change has accrued to largely the West and the global North, and all the costs of it have been borne and are being borne now by the global South. So this speaks to some sort of huge inequality that needs to be dealt with. And one of the things that is an ongoing bone of contention for me is around the money that is required today to try and support those parts of the world that are being impacted by the climate now. And I think the rough estimate that's required is $300 billion a year just now. And I think the COP26 proposals got us to 100 billion. And in a world that is so unbelievably wealthy, I find it really quite sad and disappointing that all of these rich countries that have benefited from the carbon economy can't find $300 billion to try and help mitigate the impacts of climate that have been felt today. And when you then look at the global response to something like COVID, clearly there is money available. It is a choice not to fund this. And I think that is an area which needs significant focus going forward. So when we look at climate risks, it's worth thinking about how they then impact finance. So we have physical risk. So we know We're talking about temperature, precipitation, and so on. And what that can lead to is shifts in prices. So things can become considerably more expensive. We can also have destruction, capital stock destruction, whether that is of, say, physical property. So we could have things that are impacted by the climate and they end up literally underwater. Or we could have assets that become stranded. So actually things that we can't make any sort of return on anymore because it's no longer compatible with the transition. We also have changing shifts in demands. So if you look at consumer demand for, say, meat, and they need to move to a plant-based diet, that is again a significant risk. And if that happens in the way in which the transition requires, then ultimately businesses that are dependent upon meat, so large-scale farming, for example, those investments will go to either considerably less value than they have today, or they'll shift to zero. We also have things around legal liability. So if you are funding investments, and we can maybe use technology, so looking at attribution and liability, you can say, well, as a result of the actions of this company in this place at this point in time, this has had a significant effect on the climate. That company can be held responsible. If that company is sued and class actioned, then again, the value of that investment could go to zero. We have transition risks. So again, you've got things like carbon stranded assets. So if we go to an energy mix which has low or no carbon, then anything that's to do with the carbon economy with regards to energy, from an investment point of view, those shares, those bonds, all of it goes to zero. So as an investor, you're exposed to a technological shift. We also have other things which are things like transition spillover risks, so foreign carbon tax. And so where the tax on carbon is much higher, that can impact the costs of a particular economic activity. And as that then flows through, if something is being taxed more highly, there's lower returns to the investors, and so you're then not getting the return on capital that's required. And all of this really points to a whole multifaceted approach to risk and how risk can affect investments, particularly in the long run, that finance has historically not really considered and is not being geared up to. So on the climate finance side, I think there are some significant challenges that lie ahead. So one of the major announcements from COP26 was the Glasgow Finance Alliance for Net Zero, so GFANZ, and that was done under the auspices of Mark Carney, and that was $130 trillion of finance that committed to greening, which is roughly 40% of assets globally. Now, that's positive, but that means 60% of assets globally are not positioned in this way just now. So that means 60% of assets has not committed in this way, and so there will be money flowing to activities globally that is not compatible with the transition to net zero. The other thing about this 130 trillion is that's not new money, that's existing money, and that money is committed in some way, shape or form. Now that money might flow about the system, it might move out of particular assets into other ones, but what you're looking at is that's not 130 trillion of new capital that can be deployed en masse. That's 130 trillion of capital that's going to try and shift the dial for the investments that are already there. And only one part of that kind of process is when you exit. That is when you sell an asset or you refuse to invest in something when it's positioned to you. Now, we need to green finance to maintain economic prosperity and fund the transition. If you look at the Industrial Revolution and the way in which that created jobs and economic growth, not ignoring, but obviously that led to a significant amount of carbon. But what you're looking at is that shifted globally the lives of hundreds of millions of people and probably billions of people around the world through time to increased economic prosperity. And through time, it has obviously had costs and benefits. The benefit of it has been large numbers of people being taken out of poverty, but nowhere near enough on a global scale. The transition into a green, resilient economy could do the same. And so we need to think about how we can deploy capital in a way which will fund the transition, and it will be a just transition. We also have to think about temperature pathways. So the reality of where things are today is it's unlikely to be a linear transition. So what we're not going to see is a smooth tapering off of temperature and so on, in this kind of nice, almost like a choreographed dance into net zero. It's unlikely to be linear now. So what we're likely to see is temperatures exceeding where we would ideally like them to be between sort of 2030 and 2040. That creates a challenge in getting temperature back down. But it also means there's other costs and risks that come with that. A positive thing that I think we did see coming out of COP was the methane agreement. So 105 countries, including the US, committing to reduce methane by 2030. But as the earlier slide shows, that's a huge task. But for me, I think the signal that comes from this is extremely positive, because the way in which things usually work is people will sign up, they'll have a commitment that they feel they can make, and then other people become sort of laggards and the pressure is on them to join. And so you should hopefully through time see more countries commit to this. And then once you see countries committing to it, then countries usually do more. We also have issues around engagement and divestment, and I think this is very important in the context of climate finance. So the way in which finance works, if I'm a pension fund and I'm holding 100 companies and 5 of them are highly polluting, if I sell those businesses, so I sell those shares, somebody else buys them. And that doesn't change the activities of that business. So when I'm buying and selling shares, usually it's in a secondary market, so it has no financial bearing on the underlying company. However, as a shareholder in that company, I have a say in how the business is run. And so there is a really big debate about engagement versus divestment. Because if I'm a shareholder and I'm an owner and there's enough owners, we can push the business to reform its ways, do more in terms of its transition plans, the pace at which it's going to achieve those plans, the magnitude of those plans. Whereas divestment means it just goes to a marginal buyer, and that marginal buyer might not actually be interested in the climate, so they don't care what the business does, they just want dividends, for example. So I think we have to then look at this in a more nuanced way. That becomes extremely difficult to do, because how you measure this is a huge problem. We also have to green the energy system, and I think everybody has, I think there's almost universal agreement on that. There's obviously always parts of the world and people in the world who will disagree with that, but moving to a more sustainable, low, no carbon energy system is crucial. But the next 2 points are 2 things that I took away from a presentation in COP. And we've got around 1 billion people in the world who do not have access to electricity. And there are about 2.6 billion people in the world who do not have access to clean cooking. So one of the things that has to then happen is we need sort of a global perspective on this, because for those 1 billion people who do not have access to electricity, or the 2.6 billion that do not have access to clean cooking, if somebody comes along to you and says, here is electricity, or here is access to clean cooking, or here is access to both, you're not going to ask yourself, does this come from a sustainable energy source? You're going to say thank you, because this is going to have a material impact on the standard of living of me, my friends and my family. So there's a real risk that as more developed nations who have these kind of things as a given transition to a more sustainable energy system, that in other parts of the world, the way in which electricity is generated and clean cooking is achieved is not compatible with the transition. And so what cannot happen as one part of the system moves towards being more green in terms of energy and so on, is that that part greens and then turns round to the part that is currently unable to have access to electricity and clean cooking and says, this is not an acceptable way for you to do this. So there has to be a holistic view, because the transition needs to be just. And where we have technological leaps, they have to be scaled quickly and they have to be distributed as fast as possible, so that we don't end up with an unjust transition, or at least we mitigate the risk of that as best we can. And I've already mentioned this earlier, 100 billion a year of new money is not enough where severe climate impacts are already happening. I think the current sort of estimate is $300 billion a year. So those economies that benefited from the carbon, those countries that benefited from the carbon economy, they need to step up and they need to do more to make sure that that $300 billion a year can be provided, because they've had all the economic benefit and very little of the cost. So coming on to some sort of reflections and thoughts about how this fits within the green infrastructure week, and also sort of energy transition type things. So I've talked about pension funds and asset owners with regards to infrastructure very broadly defined for quite a long time. There was a project at the University of Leeds called iBuild, and that was looking at how you could improve infrastructure in the UK, and also how could you attract investment to it. And the real difficulty is, if you're not in finance, a lot of people just look at these big pots of money, £3 trillion. Well, we could stick 500 billion of that into green energy, or whatever else we decide is required to make this transition. But that's not quite how it works, because pension fund trustees, for example, have a fiduciary duty. They're legally obliged to try and make investments which will enable the pension fund to pay out a pension to an individual. So that then means that when people are looking at those pots of money, that money can and is invested in new projects, but those projects have to meet a number of different criteria, and one of them is about risk, which we'll come on to, the other's about return, because ultimately pension fund trustees, and the function of the pension fund is to pay a pension to an individual. Now, there's a sort of longer term, more philosophical question, which is, if you don't fund these things and you're trying to get a pension in 2060, having a really big pension in 2060, if we've had global warming of 3.5 degrees, doesn't really make much sense, because you can't, there's not a lot of value in a pension in a dying planet. However, we do have to balance these things off in reality. There's also the fact, and I'm only taking the UK because it's the country I know best, but pensions regulation in the UK is inherently short-term, and these are very long-term problems. So while pension fund trustees and large pension funds have been asked to do TCFD reporting, so that's the Task Force for Climate-Related Financial Disclosures, where they're asked to do that kind of reporting, the regulation is such that it makes it very hard for defined benefit pensions, for example, to invest in the types of long-term projects that are more compatible to a transition. Now, pension funds should be long-term investors. They're often viewed as patient capital and so on, and it would be nice if we could get them back to being that way. And as I've said, 2050 is easily within the life of most defined benefit pensions. So there is a duration there which is compatible So if I could be a long-term investor and take a 20, 30, 40-year view of a large-scale infrastructure programme that meets all the different things around risk, return and so on, then that would be a great investment. And there are pension funds that do this. But the regulatory system sitting around them is geared up towards being long-term. So the regulation matters. If we also take the UK, there is about, call it about 100 pension schemes just now that have got assets over £5 billion under management. So about 100 pension schemes with assets over 5 billion. And those schemes are having to do TCFD reporting just now. But those 100 schemes, those 100 largest schemes, get you about 85% of pension assets under management in defined benefit pensions. So out of 2.2, 2.3 trillion, 85% of that sits in 100 schemes. Underneath that, there is another 5,600 pension schemes. And those pension schemes will get you 85 to 90% of all members. So when we're looking at pension funds, there are some structural things in there which are really important, because if you want to deploy large scale capital, there's only really 100 pension funds that you need to speak to. If you are trying to think about making a pension portfolio climate resilient so that the pension fund is there, something jumped in the chat which made me wonder if I'm running over. Just give me 1 second. No, okay, I'll answer that in a minute. So what you're looking at is those other schemes that need to be climate resilient, i.e. they have to have a portfolio of investments which doesn't fall foul of transition risks and so on. That's really important for making sure that in a world where we can manage climate risk to something reasonable, that all those people have a pension. So there's two different things for me within this kind of space of pensions and asset management, because we want those investments to take place. And it's really good that there's only a very small number of schemes that can really deploy capital at this scale. But there's another huge number of smaller schemes where actually it's about somebody's retirement. Now, when we're thinking about what is it pension fund trustees are concerned about, they're interested in risk and return. Potentially they're interested in resilience, and we'll come on to that, in costs and fees and performance. So when I make an investment, I want to know what is the risk of that investment and what is my expected return on it. And then I'm interested in how much does that cost me. And actually costs and fees are really important, because high costs lead to lower returns lead to lower asset values mean you're unlikely to get the pension that you expect. Now, in the context of funding things like infrastructure over a very long time period, one of the things that we can think about is the cost of resilience. So how we build something and where we build it matters. So from the perspective of a trustee, if I build a particular asset in a particular place and it has a climate exposure to it, then that is a risk, and for that risk I will expect an additional return. However, I might choose to build it differently and build in resilience. And if I build in resilience, what I've done is I've lowered the risk of that investment, which means I can also accept a lower return because that return is more certain. And you've always got this dynamic that underpins the decision making. And for where investment is just now, resilience doesn't really feature highly enough when we're talking about infrastructure investments and how something is built. And again, we've got this stuff around just transition. So outside of infrastructure, if we think about something like social housing, Social housing is an investment which has been made fairly regularly. But where do you build it? Because you can't just build it in places that are not going to be as exposed to, say, sea level rise. So you can't then decide that we'll only build things. I'm in Leeds. Leeds is not particularly exposed to sea level rise relative to low-lying coastal regions. But people live in low-lying coastal regions, so you've always got this kind of trade-off between what is it you're building, where do you build it, and how do you build it. So if you were going to build some social housing within a low-lying coastal region, you have to pick where you build it, and you have to pick how you build it, and you have to try and make it climate resilient. But the issue we then have with that is effective resilience is the dog that didn't bark. Because somebody says, well, you built it like this way, but we've never had the event that you thought was coming. And actually that's not true. The point is, the reason that asset continues is because it was built properly. But from a trustee point of view, that's a very difficult conversation, because you're incurring additional costs, and through 10, 15, 20 years out, the event that you were expecting doesn't have the impact. And so you've got this really interesting communication problem about how do you build something which is resilient and articulate the benefit of that cost such that people then accept a lower return and realise that you don't want the event. And I don't think asset owners are there yet in that kind of conversation. And then we have this, and this actually comes back to a lot of the discussions I had around the iBuild project. So I was only there sort of speaking about it, I wasn't involved in it. So I was talking about similar types of issues around investments. What is the role of government in all of this? So for me, there are a class of investments which I think are for the government to make. I think there are a class of investments which the private sector can make, i.e. pension funds. And then I think there is an interesting interplay between the two, because you've got to go all the way back to trustees having a fiduciary duty, a legal responsibility to the beneficiaries of the scheme. That means they cannot just invest in things that are speculative, and they have to be able to invest in things which have a likelihood of success, which brand new projects, new technology and so on, they just don't have the risk-bearing capacity for. And this is where I think there is some interesting developments where the government can provide some of the risk-bearing, and by that it might be some underwrite or some guarantees, or you look at some innovations around, say, the UK Infrastructure Bank, which was announced last year. So there are ways in which government and the private sector, for me, can partner in all of this. And I think the risk-bearing capacity of government is one which allows government to get things going and catalyse particular activities and investments. You de-risk it. You don't zero risk it, you de-risk it, you make it a known quantity, you create the business model for it. And once that is then there, you can then see the private sector flourish. You can see pension funds and other long-term investors come into this space. But to expect private capital, particularly in, say, pension funds, where there is this legal responsibility to beneficiaries to take more venture-type investments is a step too far. And I think there's a huge discussion to be had around all of this. And that's my sort of ramblings on musings on the state of finance. And I would be more than happy to take questions from anyone.
Yes, so thank you very much, Ian. So the floor is open for questions. Yes, so Ryan, please.
Hi, how are you? I tell you, Ian, there was one thing you didn't discuss at all or present in your presentation. You sort of mentioned it briefly, but like, I mean, there's a few things happened over the last COVID really sort of flagged it up. The fact that investment funds, so if you take, like, I mean, like we all know that the UCU, the university's pension is the largest in the UK, but it's only it's a very small pension in comparison to Caisse de dépôt in France or the federal pension in the US or the Japanese pension fund. And if you look at it, you mentioned, you know, water levels are going to rise. But you see the likes of Blackstone, biggest manager. If you go back and you see all the owners, they're the biggest owner, and there's another organization as well that own all these pension funds, that own all these investments. And really, you know, they're still continuing to invest in downtown New York, downtown London, where you know and I know, downtown Dublin, downtown Paris, they're going to be underwater. And like, I mean, what I don't understand is, you look at their salaries and the cuts or anything that they've taken over COVID, their salaries have gone up by 30%. Their profits are continuously going up, but at the same time, we'll see Shell doing a write-off. So the pressure's being put on technology and the pressure's being put on the energy sector to deliver, but I don't see any real substantive offer by the financial sector. They're well able to account for themselves, they're well able to make money, but yet when it comes to people taking a cut, it's the likes of the UCU, whose pension fund, and that's actually only the tip of the iceberg, because that's actually a mark for them. You know what a mark is, don't you? They've decided they're going to run this and see can they get it through, and half our pensions or quarter of our pensions, and they're going to take the same approach globally with all large pension funds, but they're going to still make money. So I just don't I listened to all your talk, but your talk to me was more from the perspective of private finance. I didn't see any regulatory, you talk about the just transition, but I didn't see any regulatory offer or points of what could be done. You pointed out, you know, that the third world developing countries and the number of people who have, you know, them using wood for cooking. Yeah, it's an issue, but it's not going to solve global warming. So, you know, there's a lot of sort of white elephants and herrings, red herrings in the room that are being bandied and thrown about. And to me, the people who really need to step up to the party, who've really made no contribution, is the finance sector. Oh. I'm sorry.
No, I don't disagree with that. I wholly agree with that. And what you're looking at is if you go back 5-10 years, global finance was nowhere in this. They didn't care, right?
I still don't think they're very participatory.
So, no, completely. I don't disagree with that. But what you're looking at is there are different levers within this system. And within this system, the money will flow where the money flows. The money will go to profit seeking, right? But that money actually is invested on behalf of other people. So if you take the UK, for many of them, not all, but for a large number of the pension funds, it's outsourced asset management. So you need to control your asset managers, you need to set your mandates properly, and pension fund trustees have not been doing this. There are also demographic challenges around asset owners. So average pension fund trustee a few years ago was, and this is a generalisation, but we're okay with a hasty generalisation, a 58-year-old white man. Okay, and as a 58-year-old white man who used to work in finance, you probably did quite well out the carbon economy, and there is a transition that is happening, and there is a social pressure that is coming, which trustees are stepping up to. If you look at the regulatory side, 85% of 2.1 trillion is going to have to do TCFD, and that reporting's happening now. This is the start of it, and that regulation is coming through. Now,
do you think it's too slow? Do you think they really even realise what's going on themselves? Because the bean counters, the actuaries, do they even understand it? Because they're living in the moment.
So I think it's really what should have happened is this should have been taken seriously 20 years ago, and it wasn't. And that's a failure that's manifest. That's not just in the world of finance. And what you're seeing from me just now is this shift towards ESG. And I don't like ESG because it's ephemeral, and it creates space for inaction. And I think we're not having the right conversation. So asset owners, i.e. trustees, are being asked to massively up their game. Now, when you think about pension funds, people think, well, they have 80 billion USS. The USS is big, it's in-house asset management, which is slightly better. But actually, they don't have huge pools of resource, and you're asking people to do something really difficult. So the reason I sort of have a wonder about it is I don't have answers just now.
Can I ask you another question?
Yeah.
Okay, I think.
No, just can I ask you one more question?
I think.
No, I would like to ask a question. I'd like to.
No, can I ask one more?
No.
I'm sure.
Okay.
I'm sure you can have this conversation actually after.
Yeah.
Oh, it's a completely different question. It's nothing to do with the pension.
No, just to let Ian Femister have his chance. I'm sorry about that, Ryan. Thank you very much.
Thanks for that. I don't want to come in and defend the capitalist system, but I think it's important to as Ian has outlined, for us to understand exactly what you're saying, which is that the incentives have to be aligned, so that if we do not get that the incentives for people to contribute to pensions are not there, then people will not contribute to pensions, so therefore there will be no money within that part of the system. So I have a slightly different question, really, because I think you've really outlined very well as to why there's some real challenges about mobilizing finance for where it should be going, or where we think it should be going. And so my interest is particularly in sub-Saharan Africa. And so if you look at the NDCs, the National Determined Contributions for many sub-Saharan African countries, they're they've set themselves up really challenging targets. Now, there's a question why you've done that in terms of the political economy. I think a lot of it's to do with pressure from aid funders, and maybe other people in the room will have some comments on that. But they have, and they've set them conditionally as well. So they have targets. They want to adapt because they're going to be hit. We're going to be hit the worst, as it were. So I said the question is what can we do? How can we change? What parts of the system can change to mobilize the funds that can go to where the funds are needed? And in terms of adaptation, the funds are needed in sub-Saharan Africa. So that's the main question. And I know you obviously don't like ESG, but what is the role? What do you think the role is of impact investing, perhaps, in that? Or blended finance or other stuff.
Thank you.
Okay.
So,
sorry, Richard.
That's okay.
So I think the ESG point I'm making is everything's ESG now, so everything's the greenwashing problem is manifest. And so if you look at impact investing, that's slightly different. That's much more conviction, and I think that's much more sophisticated. So it's not just here is an ESG fund, and then you look underneath it and you go, wow, there's quite a lot of large oil majors. That doesn't seem compatible with the climate transition, so it doesn't feel very, very ESG. And I also have concerns about ESG as an industry because it's what makes you an expert. I've got no sense of what is good in the space, and too many people say they do it. When it comes to the sub-Saharan Africa issue around adaptation and things like that, I think there are significant investments that can be made, but I think this also comes down to the balance between private finance and public finance in the role of government. And so just now, the issue is one of risk. So if you're making an investment, if you're a pension fund, there has to be a return on it. That means for somebody else, there's a cost. Now, what that cost should be, and if whether or not it is adequate for you as an investor, i.e. as a pension fund, it's got to pay a pension, is a very open question. So I don't have an answer for it. I think there are ways in which you could structure capital, and you could have some mixture of co-investment between government and private sector, but people aren't looking at this just now. And I think the rush towards ESG is one which is a distraction from where there are really short-term pressures, and where actually the sort of impact of the investment could be more significant, for example, in sub-Saharan Africa. But the risk aspect of that, and the sort of way in which that part of the world is viewed from an investment perspective, is one that's highly risky. And it's in part about knowledge and understanding of the sectors and the countries. And from a very Western, sitting in the UK view of the world, deploying capital into other parts of the world is always risky because you don't understand the context. So there has to be an educational piece, which I think is then incumbent upon the people who are going to provide these funds, that allows the sort of the amorphous mass that sits around all of this in terms of advisors and so on to get comfortable with that kind of investment, because that investment profile is not something that has been done historically and definitely not done at scale, and it's at scale that it has to happen.
So thank you, Ian. Let me just ask Lindsay if it's possible for us to go a bit like 2 or 5 more minutes, please. It's getting quite interesting. So before I do that, let me just say, Ian makes a statement regarding whether those NDCs are going to come into fruition and whether indeed they have the strength to make that happen. This is my observation. For example, there was an industrial energy efficiency conference, and for setting the baseline in terms of how much they can increase the efficiency levels in Ghana, there wasn't any study that was there. And so they had just said, we would double up our industrial energy efficiency by 2030. But then how do you arrive at that? So I think that's a very good question. So with the sub-Saharan case, again, with the business models, how are they going to be very appetizing to investors in terms of scale and scope of economies? So these are very important questions, and thank you very much. But any other question? Robin, do you want to ask any question?
Thanks for asking. No, I'm good. I've just found it really interesting. It's a little bit outside my area, but sorry, my camera's off as well. A little bit outside my area, but I've just found it very interesting listening to everyone else's opinions.
I was just going to say there's the question that's just been put in the chat about the just transition and zero fuel cost. That's a very interesting one. I don't have an answer for it, but I was listening to the radio on Friday, I think, and somebody was breaking down the balance sheet of one of the large energy companies. And when you then look at the profits that have been made on renewables, it's staggering. And I think that's an area that we really need to get into, but that's not really one for finance, that's one for government.
Well, can I say something to you? You know, that is something for finance as well, because they're actually heavily investing in green tech funds at the moment and green funds. It's a money-making racket. Do you know what I mean? I suppose that's one question. And the other, it's something now I just wanted to raise up with colleagues. This is another question I have for you. You said 20 years ago, you know, 20 years ago, we should have done these things. But 20 years ago, 30 years ago, in the 80s, you know, it was all about Maggie Thatcher, and it was all over the world, in America, North America, European countries. It was the dot-com telecoms boom, and it was all about liberalisation of the transport sector, selling off British Rail, you know what I mean? So I'm just wondering, has that actually, because to create the investment vehicles that you need, you basically need a government bond. So HM Treasury needs to raise bonds. So I'm just wondering, for us to do the sort of things that you're talking about and to regulate and to provide the finance to investors, is sort of a rollback or a change in liberalisation, market liberalisation sort of needed? I'm not saying that nationalisation is what we need, but how would we raise that fund, the funds we need?
So there's two different bits to that. So actually I was thinking about Mrs. Thatcher this morning. It's not something I do on a regular basis, but as a result of coming through to do this, I was thinking about her, and one of the things about the just transition is I think there were some systemic issues in the UK and around unions and all the rest of it, right? So I don't dislike unions, I don't like unions, I'm a sort of neutral arbiter in all of this. I don't have a position on them per se, but I think so when you look at what happened in the 80s around the deregulation and everything else, there was hugely inefficient businesses. They were going to get competed away anyway. The mining, coal mines and everything were a I don't think she did it for climate purposes, let's be clear, but actually there's been some unintended consequences that have probably been to the good. But where Mrs. Thatcher had she made a critical mistake, is she hollowed out all these communities. So I'm from Glasgow, so you look at shipbuilding, you look at coal mining and steel, and all of these huge heavy industries, they were just wiped out. But underpinning her thinking was the market will come in, and the market will come in, and all these people are going to get all these high-tech new jobs or whatever else, and that's not how markets work. So I think the issue is, when you think about the just transition, is when you take stuff out of somewhere, there has to be an explicit what do you put back in. And that for me is the bit that's missing quite often in the discussion. I think there's still an implicit liberalisation, free markets will sort it all, and I don't believe that's the case. And I think history has now shown us that's not the case. I think I need to cut it short over there. John, unfortunately, but if you can put your questions on the chat box, I'm just going to copy all those questions, and then once we get the recordings ready, we can attack that and with a response from Professor Clacher. Thanks very much, everyone, for coming. Very insightful